the interview with Miss Mello, and she's teaching us about finance. So we're going to talk about finance tonight. I'm very, very, very excited about this opportunity. And thank you, Mello, for allowing me to interview you, Queen. So, man, this is about to be amazing, amazing, amazing. So, I think it would be good because a lot of people here may not know who you are. So, would you like to give just a brief introduction before we actually get into the podcast so they can know who you are, Queen?
Sure, absolutely. Um, ah, I don't know what the problem is. Hold on, let me do this. Let me do this.
All right, so one moment, y'all. We're figuring it out because we're using more than one device to stream. So, of course, it's giving a little feedback, but we're figuring it out.
Unmute your mic, Mello.
Okay.
Okay,
So
perfect.
am I good now?
Yep.
Woo! All right, we're gonna get it together eventually with all this stuff. Hey guys, my name is Mel O, and I am the author of the book "Finance is the Other F Word, Another F Word to Love." I am also the host of the show titled "Finance is the Other F Word." I am also a certified financial planner. So, and a licensed financial advisor. So, to explain to you guys a little bit about what that means, there's people on social media that say they're financial coaches, and then there's the real people, which is me. And I am licensed, I'm a fiduciary, and I'm also a certified financial planner, which a lot of people do not know what that is. But what CPAs do for taxes is what I do for investments. So, I'm like the real deal. So, and I'm super excited to be here. So I'm looking forward to the conversation so much because I love financial literacy and I want everybody to understand money.
Ooh, and that's important. It's so important to understand how money works. And I think once people really get that good understanding, then it definitely changes your whole mindset. So I'm excited. I'm a student tonight. This is definitely not my forte, but I did been dabbling. I'm in payroll, but of course it's totally different. So I definitely understand what you mean about the CPAs because we're heavily involved. So Queen, again, I am so excited about this. So I want to start with first asking, like, what was your passion? Like, where does your passion come from? What made you want to get into financial services or what you do as of today?
Well, there's a couple different things. I could tell you that it's because I wanted to have a responsible job, but really the reason why is because I was raised by my grandparents and they were Depression era kids. And they were just worried about being broke all the time. And they were broke all the time. And they didn't understand money. They thought that people who had money were just trying to steal it from somebody else. And so the real reason why I wanted to get into finances is because I wanted to understand money for myself. So that's really it. But then when I got into it, I realized how they don't teach finances at all. So nobody really understood money. And so that's the reason why that's where the passion from it comes from.
Wow. So I love that because that's probably the same reason that I learned how to do taxes because I didn't want to pay someone else to do it when it's pretty simple. I think sometimes people just don't take out the time to educate themselves and that causes, for them not to be as educated as they should be or as diverse. So I want to start maybe from ground one because I know a lot of people are probably new to just they're getting that relationship with their money. So what are some good tips you can give, like starting out, like as far as investments and when it comes to financing?
Well, so this is where I'm going to be kind of sweeping myself off from the pack because the thing is that a lot of people on social media want to tell you where you should be putting your money to invest, and that's actually not what you should be focused on first at all. And as a matter of fact, because I am licensed, even if I have ideas for you to invest, I couldn't tell you because I'm not allowed to give blanket advice because I'm a fiduciary and because I can be sued. Where the people on social media who are not licensed, who are just kind of saying random stuff, there's no recourse for them. So to be quite honest with you, if you're looking at trying to do a financial plan or getting your financial shit together, the first place you need to start is with your savings account. And that's not sexy, and it's not what people like to hear, because everybody wants to try to get that big payoff, right? Where they're going to get this ticker symbol or this crypto tip or some bullshit like that. And then all of a sudden they're just going to be swinging for the fences. Well, before you do any investments, you need to make sure you're just going to be swinging for the fences. Well, before you do any investments, you need to make sure. Hopefully you guys can still hear me. I'm gonna actually, you know what? I'm gonna do this. I'm gonna drop out of the clubhouse real quick, because I don't know if that's what's doing it. So let me do that.
No, you're fine.
Oh,
I found
okay.
out the problem is, yeah.
Okay, right on. So the thing is that before you start investing, you need to have a savings account, and this is a general rule of thumb, guys. Okay. For a household with 2 incomes, you need to make sure that you have 3 months worth of expenses on the sidelines. And that would be discretionary and non-discretionary, fixed and variable. If you are in a 1 income household, you need to have 6 months worth of those expenses in a savings account before you even do investment 1. So do a 401k with your employer.
Wow. So one moment we're gonna take a small little intermission. I think Clubhouse kind of threw me out for a second, but it's okay. It's okay. I want to make sure we don't miss our audience. Are you able to unmute on Clubhouse, Mel O? I just want to see. And you can mute here. I just want to tap in with them until I can get back in there.
Sure, hold up.
Right, little intermission. We're gonna get this thing popping. Thank you all so much for joining us. We appreciate you all. I will be back in Clubhouse momentarily, just having a little difficulties. One moment. Kicking me out. All right, you can mute. All right, so we are back, and thank you so much, Mel O. Clubhouse kicked me out for a moment, but it's okay. But we still are here live streaming. For anyone who would like to join us, definitely go to the Loyalty and Friends Facebook page, and you can join us live there. So thank you all, or on YouTube as well at Loyalty in Everything. So thank you, and so I apologize, Mel O, if you want to kind of give them that information again, where we should start. I know you was stating about the savings account, so we can pick up right there.
Yeah, absolutely. So, okay, still getting a little bit of feedback. I'm not really sure what to do to stop it. So, yeah, so the thing is that when people look at doing investments, they always want to have the hot ticker symbol, or they always want to have the hottest crypto that they should be investing in. But really, before you invest $1, you really need to make sure that you have a savings account. And the general rule of thumb is if you're in a household that has 2 income earners, then you want to have 3 months worth of expenses. That's discretionary, non-discretionary, and fixed income and variable. And then if you are in a household that has only 1 income, then you want to have 6 months. So if there's 2 people, you want to have 3 months of expenses. If there's 1 person, you want to have 6 months of expenses.
Oh wow, that's good. Okay, and so once we have that savings, then what's the next step? What's the next suggestion?
Well, the next suggestion, and I know it seems counterintuitive, but the next suggestion is you need to know what you're investing for. And so let me give you an example. A lot of times people come and they sit down in front of me and I say, okay, why do you want to invest? And they say, well, I want to make money. And I go, okay, great. What do you want to make money for? And then the next thing that they say is typically to put my kid through college, or to retire early, or to start my own business, or to go on a trip to Italy. That's the thing that you should be focused on. Because if you don't know why you're investing, you're going to fall for any BS that anybody on social media tells you that is not legal for anything that they're not liable for anything that they say. And also, there's a lot of people in my industry too that are unethical. And so the thing is that what should happen is your portfolio needs to work around your objective, not the other way around. So people always want to start with the portfolio and start with the ticker symbol, but that's backwards. You need to understand why you're investing, because that objective is what drives your overall investment strategy.
Mm. Oh, that makes a lot of sense. So I want to speak a little bit about your podcast, okay, Queen, because I do know that you have a podcast kind of built around giving a lot of these financial tips. So for one, definitely let them know where they can connect with you as far as your podcast. But how long, I want to know, like, how long have you been doing the podcast? And like, I know that's a little different than your career itself, but what made you want to do the podcast? Is it to reach a different audience, or what in particular?
The reason why I do the podcast is because I have a background in media. And I launched the podcast in 2019. I have 387 episodes right now.
Wow.
The reason why I did the podcast is because I see all these people who are chasing the wrong thing. They're chasing ticker symbols, and they're chasing hypothetical investment returns, but they don't really understand the interconnectivity of money. And the thing is that when you're licensed, I can't go on my podcast and say, hey, you guys need to be buying these types of stocks right now, or you need to be buying these types of bonds right now. I can't say that because I can't give blanket advice, because it's a liability. And so what I did was I was like, how do I teach financial literacy in a way that people can understand? Because it's not about picking a stock. It's about, you need to understand what cycle the economy is in when you're investing. You need to know what cycle of life that you're in when you're investing. And so when I launched the show as a way to explain to people how finances worked in a manner that is easily understandable, so that they can understand the relationship of money. And so the show talks about, like current events versus, everything from like David Bowie and Bowie bonds and how they work, and then to defunding the police, the politics behind that, behind just the economics of discrimination, the economics of the Supreme Court, all these types of things, who really controls the price of oil. This is all stuff you guys need to understand, because if you don't, then you're not going to understand the relationship of money. And that's what's the most important. And in my opinion, obviously.
Awesome. So I see a question that came in for, I guess, one of our listeners, and it does state, do you think about the new ETFs that match all the trades of politicians? Politicians. It says there's one now for Nancy Pelosi.
Yeah. So, let's see. How do I be nice? And it's not that I'm trying to be mean. It's just so the belief, these ETFs. So just for you guys out there who are listening who don't know what an ETF is, an ETF is an exchange traded fund. Okay, and it trades just like a stock. It trades the minute you put it in. The trade is executed. It's not like a mutual fund where it doesn't go until market close. And ETFs can be based on a whole bunch of different things. So the popular thing out now is where people believe that politicians have insider trading. And to be fair, they probably do. A lot of them where they are in bed with everybody. And so therefore, when their crony is going to make a big move in a company, they're going to tell the politician, and the politician at that point is going to decide if they're going to take the risk of do insider trading, which is where they front run everybody else to either buy or sell shares of stock. And this is what happened to Martha Stewart. And so there's ETFs out there now that are designed to try to track what the politicians are doing in the hopes that they have some type of insider trading, and that they're going to be able to put a trade in before everybody else, and that you can either get out early or do whatever. And my caution I have with that is that Nancy Pelosi, in this example, she's in a very different economic space than most people who are investing. There's the 1%, okay, Bezos's, Elon Musk's, Warren Buffett's, Nancy Pelosi. Then there's 99% of us. That's everybody else. And a lot of times what happens is that they focus on one part of the equation and they think that's the entire equation, and it's not. The people that are doing this have more money than you, have more information than you, and they can be a lot riskier than most people. And so what we find is that a lot of times when they're trying to track what the politicians are doing, even though their strategy is good in the sense that it sounds like it's a sound strategy, it's not always it doesn't always correlate to what it is the person tries to do. So I would, for me to buy an ETF like that for a client, it would have to match up with their risk tolerance, their time horizon, their taxable situation, and their goals before I would buy it. I don't give a fuck if it's tracking, Nancy Pelosi or Donald Trump or Obama or anybody. It needs to be appropriate for you.
So thank you so much. And that question came from Ms. Cara, I believe it's Grandel. So thank you for tuning in. We truly appreciate you for the question and just, getting that enlightenment for what you needed. So hopefully that answered your question, and now you'll make better decisions when it comes to that investment. So with that being said, I think it would be good. I see we got a lot of people here on Clubhouse listening in as well. So we have our brother Eric Allen in the building. Hi, Andre. Thank you so much for joining us. We have Reverend Latrell Bailey in here as well. The Alias, as well as Mr. David also. So thank you. He's in the listening lounge. So of course, you all can also participate if you have any questions for Ms. Mel O. This is to enlighten you and to really get the financial, that elephant in the room addressed. I think a lot of times, we end up in a lot of financial deficits because of, it's not about how much you make, it's how you invest in what you have in particular. And that's what I've been learning. Just, make sure you put something to the side. You can't spend it all. If you spend it all, then you're going to continue to be in debt. So thank you so much, Mel, man. I'm really enjoying this. I'm learning so much. So with that being said, what are some tips you would give for maybe the youth? Because a lot of times I think we should start incorporating that financial literacy at a younger age. You understand? Like, what are some things we can incorporate with our kids and teach them at this stage, even if they're not an adult at this point? You're on mute, Mello.
I dropped so much knowledge right there, and then nobody heard it. It's a damn shame. No. So if you are trying to give some financial knowledge to your kids, there's a couple things that you can start that's just very fundamental. You can start with explaining compounding interest, because the thing is that a lot of people, they buzzword this, but they don't really understand it or the reason why it's significant. And the reason why it is, and I talk about this in my book, is because of the simple fact that compounding interest works for you and against you. So everybody on social media, they want to get all excited about talking about compounding interest because they understand a financial concept that they just Googled, but they don't talk about how on the flip side with credit cards, it works against you. So the best way I can explain compounding interest is, like, let's say you have two trees, okay? And you have a oak tree and you have an apple tree, okay? An apple tree is going to produce fruit for you. So not only do you have the tree, but you also have the fruit. That's how compounding interest works versus like something that, like, there's stocks out there that don't pay you dividends that only grow. So that would be, in this example, like your oak tree. It's just going to grow and be pretty and gorgeous, but it's never going to produce anything extra for you besides growth. Where if you have a fruit tree, what happens is that it's continuously producing something for you. So if you put $100 into an account and you earn $2 in interest on it, then what will happen is that the next time you get paid interest, you're going to get paid interest on $102, not the original $100 that you put in. And that is how compounding interest works. However, compounding interest also works the same way for things like credit cards, which compound daily. And the thing is that when kids go off to school, and I did a show on this, when kids go off to school, they get thrown these student credit cards, like easy credit. Maybe it's only $500 credit limit or whatever. But the thing is that the interest rates on them are extremely high, as they would be because the person does not have established credit yet. However, if you don't make sure that that the person who is carrying the debt knows how to actually use the credit card effectively, then it's going to end up working against your child, and it's going to end up setting them on a really bad course. So that would be the first thing. And then I would just explain to them the difference between FDIC insured product and a stock or bond, which is not FDIC insured. And that would be more than most people get. Well, you can go to the financestheotherfword.com website, and all of my episodes are there. You can also get my book, Finance is the Other F Word, Another F Word to Love. That information's in there. And also I have a YouTube channel under Finance is the Other F Word, where I put things on there. And I have a TikTok channel where I talk about that stuff as well.
Loyalty, you're muted. I think the screen froze. Here she comes. Please unmute. Unmute.
Give me 1 second, y'all. We have a small interruption from our broadcast. Can you all hear me?
You're fine now. It sounds good.
I'm sorry, I can hear you.
All right. And can you all hear on the live stream? Are you all able to hear?
Yes.
Yep.
Unmute.
All right, let's try it now. Can y'all hear me now? Awesome. Okay. So small little interruption. It's okay. I think this would be a great time just to take a small little break and maybe get some music in. So give me one moment. Let's see. All right, Mel O, do you mind unmicing? Because I can't hear anything on here at all. I don't think so.
Yep, I'm here. Do you want me to unmute it?
Yeah, I'm gonna have to come back. Give me 1 second.
Yeah, I've been muted because I just want to add to the feedback. So just tag me in. I'm going to mute myself back in. Hey, LP, Do you think I need to leave Clubhouse?
No, your sound is okay.
Okay, all right.
Okay. All right, I'm back. I'm back in the building. Can you all hear me? Awesome. So yeah, so where did we leave off at? I'm ready. Let's get this thing going. Mello, I appreciate you. And we want to kind of stop it right at 9 to give you some time back. But I want to open it up to the people here on Clubhouse to see if they have any financial questions that they may can ask and tap into this beautiful, beautiful podcast. So one moment. Stop the music. All right. Awesome. So for those here in Clubhouse, we have the alias here on the stage. We got Mr. Andre, and we also have our brother EA. So we want to open the floor just for a moment to see if you all have any questions for our beautiful guest, Miss Mel O. And I truly thank her for this opportunity for sure. So open mic, I start with our brother EA. Are you available, King? Do you have any questions for Mel O today?
No, I don't have questions, but I definitely want to give her a shout out for being just, you know what I'm saying, so transparent and just laying out there, giving us all this game, you know what I'm saying, no matter the size of the room, no matter what's happening, you're still on your A game. I really, really appreciate that. And shout out to you too, Loyalty, for, you know, this is your first time doing something, man. I applaud your efforts. Keep pushing. Let's go.
Awesome. Thank you so much, EA. We appreciate that. And with that being said, I want to move to our brother Andre. So thank you, Andre. We appreciate you so much for your support. Do you have a question for Mel O today relating to finance?
The question I would probably ask is probably go into a little bit more about how people are using their CDs and their stocks and bonds and things of that nature. How would it be best doing it? Because banks have CDs where they hold it for a year. They have people who tie up their money for a long period of time. What would be the best option to go to?
Okay, so you're kind of breaking up there. So you said about using stocks and I'm sorry, what was it?
And CDs.
And CDs. What was the question?
A lot of the banks use the CDs, and they hold people to put in money into the CDs to use sometime up to a year, and they can't touch it for a year without a penalty. What would be best something that you would say some people should invest in that would not hold their money down for a year or so?
Okay, so I think I'm going to do my best to answer the question. If as I heard it, it was still a little blotchy. So so yes, with CDs, I think what you were saying is where could they put their own money that they could invest in shorter term than 1 year than say like a 1 year CD. I think that was one of the parts of the question. Is that correct?
Yeah. So his question basically exactly what you're stating, and he wanted to know what other investments where they're not going to be penalized, you know, or where it's not like a certain term where you're not able to touch the funds. So what would be some other investments?
Well, so I mean, the thing is that more importantly than your time frame, you need to decide if you want to go FDIC insured or not FDIC insured. Because the thing is that a CD is a federally insured instrument. So the thing is that it's not going to lose any money. And the fact that if you put $1,000 in a CD, it's going to be $1,000 plus it's going to get interest, assuming that you keep it for the entire term. However, that's something where you're not going to lose money. The thing is that when you start talking about investing is not FDIC insured, which means that there's no guarantee against loss. And people, they get excited and they want to buy into the stock market, but they don't realize there's 2 points. There's a point in and there's a point out. And so the thing is that if you had money that you didn't even want to tie up for a year, I would tell you that the stock market isn't even any place you should be investing. Because the thing is that in all of your investment strategies, you have different buckets of money. You have a bucket of money for your ultra short term, which is 12 months or less. Then you have your, short-term money, which would be money that you're going to need within 1 to 3 years. And then from there, you have your intermediate money, which is going to be, say 3 to 6 years, 3 to 7 years, which is your intermediate money. And then from there, you have your 7+ or 10+ years, which is your long-term money. So if like we're sitting in front of me and you're like, hey, I got XYZ money that I want to put somewhere, but I don't want to be tied up. The thing is that you have to know your time horizon of the money. And the thing is that depending on your time horizon of the money is going to depend on where you put it. So let me give you an example. If you have, I don't know, $5,000 that you don't care if you lose you don't care if you lose all of it, right? And you have eons, then you might be a speculative investor, which means that you can put your money in something that isn't tied up, because anytime you buy like a stock or an ETF or a mutual fund, depending on the structure it's in, not 100%, but you can sell it at any time. And so the thing is that the time horizon is based on whatever your financial goal is for that money. So I would be more concerned with making sure that the investment aligns with your risk tolerance and your financial goal than not locking it down for a year. And I don't know if I answered your question or if you can follow up on that.
All right, Andre.
That was good.
That was good. Did you have any other questions? She's here. This is her field. She gets excited about these type of conversations. So any questions you can think of, they are welcome. Okay. So open floor. Do you have any other questions before we move on to the alias?
No, I'm okay.
Awesome. So that brings us to our brother, the alias. Thank you so much for joining us on the stage, brother. Do you have a question for Ms. Mel O relating to finances or anything we can enlighten you with tonight?
Oh yes, ma'am. It wouldn't be right if I didn't have at least one question to contribute. So that being said, it's certain instances. I don't know how to describe this question, but I'm gonna try to do the best to kind of show you what my curiosity is. I know it's like certain monies. Like imagine okay, this is a perfect way. Okay, like a landlord can put a deposit. What's the deposit you call when you first the security deposit or whatnot? They can, let's say the landlord have 100 houses, and each security deposit is $1,000, and he written all of them out. So he got $100,000 inside of a segregated account, because it's not really his, but it's kind of related to the put to the side, like he can collect the interest, I think, off of it. I'm not sure, but what kind of things can an individual do with money that they have access to, but it's not theirs? Like, is it certain kind of things in the industry, like could you buy another house or is using it as collateral? Because I hear about certain instances where it seems like people use money that they don't have as collateral, or money that they have but they're not using as collateral so long as they don't touch it, and it's going to be there for a long period of time.
Okay, so let me try to address that.
I'm so sorry too. I know I'm the most difficult person, especially when I'm confused myself.
No. I mean, well, the thing is that what you're saying is not what you're saying. It could be a lot of different things. So that's why I'm trying to figure out how to approach it. So let me back up for a second. So there used to be, back in the day, where you could take a CD that is FDIC insured, and you could secure it against a loan, and you could get some cash by collateralizing or using the CD as the actual security to the loan. Then there's, as far as in different accounts and being able to use somebody else's money, I think you might be talking about margin or options. So let me tell you what that is, and let's see if that's kind of the question you're asking, because you'll hear a lot about this on social media. Because margin is sexy and because options are sexy, they're very sexy. However, if you don't know what you're doing, you can really, really be detrimental and blow yourself up. So there's margin. Margin is where you borrow money from the broker dealer that you're with,
and you use that money to buy stocks with it. And you're hoping that you're going to be able to buy the stock at a low point with somebody's money. Like, let's say, you're going to buy the stock at $10 a share, borrowing somebody else's money, or a half of, the share price you're going to borrow, and do it on margin. And your hope is that it's going to increase to $20 a share. Okay. And if it does, then what happens is that you sell this stock at $20, you pay back the broker dealer the money that they let you borrow, and then now you have the difference between what you paid for it plus what you sold it for. So you have the gain in between, but you actually weren't the one who put up all the money. So margin's very sexy. The deal is, though, is that if the stock moves against you, and let's say that you bought the stock at $10 a share with the expectation that it was going to go to $20 a share, and the stock moves against you, now you're going to be constantly in what's called a margin call, where you're constantly having to pay your broker dealer money, because you need to have a certain amount of equity in a certain amount of account value in order to keep you free of a margin call. So that's a margin call. Then there's an option, which is literally where you bet on the direction a stock will go. If you think a stock is going to go down, you're going to short it. If you think the stock is going to go up, you would go long on the stock. Does any of that sound familiar to kind of what you're asking me?
Yes, that sounds perfect. It's exactly what I was looking for.
Awesome. Thank you, Mel O. Good job. So we have another comment from Kara as well. So Kara asked, well, her question was, as far as savings for an emergency fund, should that be in a high yield savings account? You're on mute.
All right, one more time. Yeah, I keep muting myself just to limit any background noise. So I think what's the most important thing is that it's just in a savings account. A boring, bland FDIC insured savings account is good enough. But this is the thing with high yield savings accounts, you guys, is that there is something that's called, people call it lazy money. I call it dead money. So when we started this, I told you guys about how the general rule of thumb is if you're in a two income household, you need 3 months worth of expenses set aside. If you are in a 1 income household, you need 6 months of savings set aside. Now, a lot of people will do that, but then they'll keep saving for whatever reason. And then what happens is you have a lot of dead money sitting around. And typically that's when high yield savings accounts come in. Now you can find a high yield savings account with an online bank. And you might not have a high balance that you actually have to keep. But most of the time, when you're talking about any type of high yield savings account, you're talking about thresholds of $25,000 to $50,000. And typically for most people, they don't need that much money in savings. So I think the focus should be more on getting the money in an FDIC insured account, more so than worrying about it being high yield. However, especially like in times right now where interest rates are going up, every savings account is going to start moving higher as far as interest. So that's going to kind of change the high yield game. And a lot of times there's kind of pros and cons with that. And with the savings account, you guys, another reason why you don't want to have too much money in savings is because even though you're not losing money in the fact that you're not losing principal. So if you open a savings account with 50 grand, unless the bank goes completely TU and FDIC doesn't kick in at all, which is what almost happened in 2008. The thing is that you're always going to have that 50 grand plus some, and everybody's like, oh, put it in savings, you can't lose money. Well, you're still losing it to taxes and inflation, because savings accounts are not designed to outpace inflation or to outpace taxes. So that's why you want to be very consistent on your numbers, so that you have exactly in there what you need to have in there, or whatever your number is that you're comfortable with. Then from there, you branch out to, hey, what investments would I like to do? What are my long-term financial objectives? That type of stuff.
Well, Car, hopefully that answers your question, Queen. And yes, if you have any other questions, feel free, to ask. We would love, love, love the questions. But I do want to, give respect to Mello, and I appreciate you, Mello, just for even taking the time out to do this. I think we're gonna definitely have to have another podcast so we can be just more intentional and have even more value to bring to the community, because I've learned a lot tonight. But I think, we can't learn it all in one night for sure. So that definitely will create a follow-up. So I would be maybe do this again in another month. We can bring.
Yeah, that sounds great. So, couple things. Yeah. So first of all, you're right in the fact that it feels like they're offsetting it, and they absolutely are. And so this is what happens. Anytime you do, I'm going to use a secured credit card for instance, so that I can kind of segue into what you're talking about, like in your example of a 6-month loan. Okay. So with a secured credit card, this is what happens. You give a bank or a credit card company, whatever their minimum is, $500, whatever, right? And then they give you a credit card with a $500 limit. And they also give you a credit card with double-digit interest. And what happens is that a lot of times people take that and then they're trying to maybe rebuild their credit, or they're trying to establish credit, or whatever the case is. And so you take that credit card and it works like any other credit card. You go out and you shop with it and then you pay it off, because it's not like a gift card where it's like, here's my $500 in my example, and you just spend out $500. That's a gift card. That's not a credit card. So the credit card is where you would just continue to use it. Now, if you're talking about a 6-month secured loan, which I don't really know a lot of establishments that do that anymore. But the thing is that yes, they are making money off of your money, and there's virtually no risk. So the thing is that that's why you need to be aware of when you're doing any type of secured loan. You first of all need to have it long enough so that it's going to actually help improve your credit. So let me give you an example. Everybody thinks that every single month the financial institutions report to your credit bureau, and that's not how it works. Okay, what happens is that every time a financial institution reports to your credit bureau, it costs them money. All right. So if you're paying on time, what they're going to do is they're going to sit on it. And in 3 months, or maybe 4 months, or maybe even 6 months, then they're going to go and they're going to hit your credit, whichever bureau they report to, or maybe all three, which typically they don't unless it's a mortgage. And they're going to go, and then they're going to hit your credit report for all of those positive payments. So if anybody out there is trying to rebuild their credit, you'll find if you keep pulling your credit report, you're like, nothing's updating. Your credit score isn't moving, because the financial institutions, if you're paying them, don't want to be reporting to the bureau, hey, this person's paying me on time, right? They're going to bank it, and they're going to do it when they can just do it all in one swap. Well, the thing is that when it's a secured account, there's really no risk to them at all, but they are exactly still paying you higher interest. So that you're paying them the interest on your own money. But I would caution you that if the drive for, and this your example of a 6-month loan, if your example is to, or your drive is to rebuild your credit or establish credit, having a 6-month loan is not going to do it. It's not going to give you enough credit history to make anything happen for you. So this is what I tell people. As I tell people, get a secured credit card, and they're going to charge you a ton of interest. I'm not even lying to you. They're going to charge you right now, with the way interest rates are and the way they're going up, you're probably looking at 27 to 29, 30% on a secured credit card, depending on how crappy your credit is. And that's with your own money put up, which sounds like total shit. I get it. Okay. But hear me out. So what you do is you put up collateral, and then they're going to give you a credit card, and just use it to buy gas, just 1 tank of gas a month, or maybe 2 tanks of gas a month. You're going to go ahead and use this credit card. And then instead of paying it off at the end of the month when you're trying to establish credit, what you do is you take and you go, okay, my 1 tank of gas was $100, right? And so what you do is you pay $80 of the balance down, and then you carry over $20 to the next month, because that starts establishing credit. A credit company is not going to be reporting to your bureau if you're just have your card, and this is with any credit card, if you're starting out or trying to repair, if you're just taking your card and you're buying stuff and immediately paying it off, that's not building credit. That's using a debit card. So if you take and you use the secured card or the student card or your first credit card, whatever it is, and you do it that way, then the next month you carried over $20, big deal. You pay it off, and then you start the process over, and you do that for about a year. And then after you do that, what's going to start happening is that there's going to be enough positive things that have hit your credit bureaus that people will start sending you unsecured credit cards in the mail. However, those unsecured credit cards are still going to have outrageous interest rates. Okay. But as the more you reestablish your credit, or the more you establish your credit, eventually what happens is the rates on those credit cards start going down. So it depends on what the purpose of the 6-month loan is. And right now, with prime the way it is, I mean, they're going to be putting prime on a spread, and I think prime is at close to 4% now, with this last rate hike. So I would assume that on any type of secured loan, they're probably putting you at about 7 or 8%, depending on credit. That's would be what my estimation would be, the going rate would be, because prime is the interest rate that the richest, most wonderful credit people get, and then everybody else gets prime plus a spread in favor of the financial institution. So you are right. I mean, they are screwing you a little bit. I mean, that's how they make their money, right? I mean, it's crappy, but it's true. So, I just want to paraphrase what you said to me. So basically she got a car loan. She wanted to start paying down the principal by like an extra $100 a month. And, you recommended that she make the normal monthly payment for a year. And then she looked at refinancing. Is that correct? Okay. All right. So in answer to your direct question, no, the advice wasn't bad, but let me give you some things to think about. Right now, she wouldn't want to wait for a year and refinance because we're in a raising rate interest environment. And so the deal is that there's a very good chance that in a year from now that her interest rate is going to be significantly higher. That's even with a year of credit paying on time and having good credit, and even with her assuming that she's paying down some of the principal, but because all loans are amortized. And so the thing is that, like, let's take a house loan for an example. If you have a house payment that's $1,500 and it's a 30-year mortgage loan, and your first payment of $1,500, you're thinking, okay, $1,500, I'm paying some interest and I'm paying some principal down, which makes sense. However, what they do is they amortize loans, which means they upload them with interest, because the bank wants to get all their interest first before you really start paying down any of the true money you owe them. And I'll tell you why that is in a minute. And I also cover this in my book. So check it out. So I'm just going to use these numbers and throw them out. So don't, live and die by these numbers, but follow with me. You make a $1,500 payment on your house, and $1,300 of it goes to interest, and $200 of it goes to pay down your $250,000, $400,000 you borrowed. And then what happens is you keep doing this over and over and over. And then so every single month, you're still paying majority uploaded interest. So now in this example, I used a 30-year mortgage. You get to about the 15-year mark. And now what you'll notice is that your $1,500 payment, now it's flipped finally. So $1,300 of that payment is going to the principal, and $200 of it is going to interest, because what they did was they amortized you, meaning that they uploaded it with interest. So check this out. Let me tell you why the bank does this. Well, because one, it limits their risk, which is, again, it's bullshit, but this is the truth. It limits the risk. So if they make you pay, in my example, you take out a 30-year loan on your house, you get a house for 30 years, 15 years into it, you decide you want to sell your house. Okay, well, they got all their interest, didn't they? They got all their interest on the 30 years that you took the loan out for. And now you've been just...
One moment, you all, I'm having some technical difficulties. I'll hear again.
Could you not hear me?
Apologize. One moment.
But she answered the question.
Yeah, you were clear.
Did you hear what she stated?
Yeah. She was going into the amortization schedule and whatnot. So yeah, I heard the question. It happened 6 years ago, so it kind of worked out for her. But she answered my question, because right now it's the expectancy of the interest rates and all of that, because the market is where it said is going up. So it would actually be a extremely bad decision to do now. I guess maybe it worked out for her because the insurance rate had been going down. So I think she lost a few payments off the back end, but it didn't seem like she benefited as much as I thought she would. But she did lose a little bit of the payments off the back end, and kind of saved a little money.
Yeah, the thing is that depending on if interest rates are up.
So Mel, give me 1 second. For some reason, I can't hear the audio again here on the stream, so I might have to leave and come right back.
Okay, but
give me 1 second, because we want to make sure we're getting
right, because I want to finish addressing your question.
It's not cooperating right now, so it kind of kicked me out and froze up. So I'm going back into the stream, but I know you two are still there. All right, there we go. There we go. So that's better. I don't know it's going in and out, so I apologize, Mello. To what he was stating is he did get the gist of what you were stating as far as that investment, as far as the car. He stated that she got a little profit on the back end, but she did lose quite a bit of the funding for that. So Alias, if you, she can hear you now, if you can tap back in, King. I want to make sure that we really give you some value for what you're asking.
Oh yeah, yeah. So it was like 6 years ago when she originally bought the car. So I guess the interest rates was going down or whatnot because when she did refinance, and I just advised her because her credit was like really good, but she didn't have anything established. And then so she had everything removed off of that, but she really, you have some people that always pay for everything with cash, and so they really don't have any accounts on file that's been there for a year or two like that. And so I just assumed that it probably would be better because I know she pays her bills on time, but she did refinance at the end of the year, and she instead of going, she wanted to go with the same company, and I told her to use the Credit Karma, and she found one of those rates on there that was a little bit better. So I think she lost like 2 or 3 payments off the back end, and the rate went. I mean, and the monthly payment probably went down like $35 a month or something like that. So she was happy. But I understand what you're saying is now the expectation of the interest rates and whatnot or it's guaranteed they're going up. So it wouldn't be a smart idea right now. But I am kind of curious because in the beginning, it wouldn't be a good idea now, but I think that's more in relationship to like housing, because you were drawing the distinction between the housing and the car auto loans.
Yep.
Awesome.
So
thank you so much, Alias. Oh, go right ahead, Mello.
no, I was just going to say, so you are correct. 6 years ago, the interest rates are going down. Now the interest rates are going up. The point I was making with the amortization is that it's important to know that anytime you refinance anything, all that interest is uploaded again. So that's the reason why, even though she had, when she did a refi, she only had about $30 drop off her back end, because every time you refi, you upload the interest again. So you need to make sure that the interest rate that you're getting, even with all of the amortization starting over on the loan, is going to be worth it in either payment or whatever the case is. So yeah, I mean, it depends. Sometimes I tell clients to refi stuff. Sometimes I tell them not to. It depends on where the interest rates are and specifically what their objective is overall.
Okay, and then sometimes, I mean, is it correct that like depending on which car company you go with, like some financial, well, this is the financial side. So it's some institutions to where you can literally pay $100 over your bill every month, and then let's say 12 months later you short for your car note, and because those extras don't really apply they don't really roll over, if you follow me, that you can get behind one month and then face a repo. Even though you paid the extra $1,200 already, so if you lose the repo, you would lose that as well.
Yeah, you're absolutely correct. Yeah. So the thing is that as you're paying down, you're paying down on the principal, because when you're paying that extra money, that's what you're doing, is you're paying down the actual principal if the bank even applies the payment correctly. Because if you just make an extra payment, like let's say your car note's $200 and you pay $400 a month, well, if the financial institution doesn't even catalog that correctly, then they just keep paying it as a normal payment, meaning that the bulk of it's probably going to be interest. You have to tell them this is a principal only payment for them to be able to put it correctly for you to start seeing your actual balance going down. And so you are absolutely correct. If you are, ahead, if you paid an extra $1,200 and it's only for principal, and you miss a car payment, they decide to repo your car, you absolutely just lost that $1,200, and the bank got that. If you are making just extra payments and you're a couple payments ahead, depending on how they catalog them, maybe they wouldn't put you in the repo if like you maybe paid 6 normal payments, but they didn't catalog them as principal only payments. So, I mean, it is in any financial transaction, a lot of times it's very lopsided towards the bank, but you're 100% correct. You lose that money. You absolutely do.
Yeah, and see, I was just going by on the school, like in the first year, like let's say you just paid that extra $100, but you didn't designate it for the principal, and they just applied what they want to apply. It was more frugal for them. Then the majority of that extras is buying into the interest as opposed to the it was pretty much all going into the interest, because in the first year, it's on average like less than 20%. Is going towards the principal from the starting, whether it's a 3-year contract or a 5-year contract, it's pretty much the same, right?
Yes, correct. So if you're just paying over and you're not specifying it's principal only, you're correct. You're just paying down the interest faster. That's it. Which is for the bank, right? I mean, that's what you're doing. You're paying the bank's interest.
Right.
Yeah, so thank you, ladies. Was that it? Did that answer what you needed? Did you have any other questions? And if not, we'll move over to Mr. Andy, but I wanted to make sure.
I'm good, yes.
Awesome. So thank you so much. Those questions was very much needed and brought a lot of value to this conversation. So thank you. And Mr. Andy, we want to thank you so much for joining us on stage here in Clubhouse as well. And I just wanted to see if you have any questions for Miss Mel O. Of course, she's definitely giving us some financial advice. That's her forte. And hey, she gets excited about these questions. So anything you would like to ask pertaining to finances?
Well, there's financial advice and there's philosophy on spending money. They're two distinctly different things. The last speaker, I would have asked, did she buy a new car or a used car? Because that's how you can save a lot of money and even get a lower interest rate. But again, it was a 6 year ago purchase, so irrelevant. But the question I had, are all loans? I mean, don't you have to make sure before you prepay a loan that you can prepay a loan? Some loans are not, they don't allow prepaying. And don't you have to qualify for that? Or don't you have to know if it's possible to prepay? Because it's my understanding that some loans are not prepayable and some are.
Yeah, no, you're absolutely correct. So the thing is that sometimes they'll have prepayment penalties. So it used to be if you took out an equity line of credit on your house, if you close the equity line of credit before 3 years, they would charge you a $500 closing fee. And then some loans, depending on how they're set up, they will charge you prepayment penalty. So yeah, that's absolutely correct. And it just depends on it. And that should be something that I'd like to say that should be something that should be disclosed at the time of signing, but really, of course, it always falls on the onus always falls on us, right? To make sure
that would be my suggestion, to ask that question before you get the loan. Because if you have an intention to pay down your loan quicker, you better make sure you get that type of loan. So that's what I wanted to add. Anyway, thanks for that.
Yep.
Awesome. Thank you, Andy. We appreciate that information. I see the alias has unmiked. So, brother, you have something for us?
Oh, yeah. I just wanted to thank Andy. It was a used car. And it was a used car from one of the dealerships. But, they have the accrued interest. It's like the scope of things now, especially when you don't get a car from I guess a bigger dealer, but now it's like the interest is accruing 365 days a year now. It's the format for those purchasers who don't really have credit, or really don't have established credit history. Is that uniform all the way around the board? Like if you have good credit, is the interest rate is. I know when I was in school, it was once a month. I mean, the norm was once a month, 12 times a year. Was kind of like the norm how they taught us, but then when you look at some of the smaller car dealerships, they're accruing the interest every day. So that has to add up to at least, $1,000 or something a year,
So as far as
a $20,000 car.
Yeah, so I think the question was as far as in regards to compounding interest. So typically, so in answer to your question, I don't think, but I don't know for sure if car loans do compound daily. They might actually compound monthly. Credit cards compound daily. It's different because credit cards are revolving and you can, pay them down and drop them again, et cetera, et cetera. But anytime you do a loan, it's a set payment with an end goal in sight in a certain time. So the thing is that the interest is accruing, but I don't think it accrues daily on a secured loan. And I could be wrong on that. But I mean, yes, the payment is monthly, but the interest, like the same thing with your credit card payment is monthly, but it compounds daily as far as on the credit that you, the interest that you owe.
Which is right. This is not the security loan. This is my automobile. And a lot of where I'm at, a lot of the local, they have what you call in-house financing. It's kind of like a substitute for the normal financing with going through the bank. So when it's in-house financing, it's like the car dealership knowing what the banks make, and they kind of creating a format for them to do it because they see the banks benefiting for it. So in those contracts, like I looked at them and read the back, and it was 365 days is the every day the interest accrued. So that's what it was kind of puzzling. But yeah, in the in-house financing with some of these small car dealerships, they're accruing it every day.
Yeah, and just when I say secured loan, when a finance company looks at a loan, anything that they can take from you, if there's a loan that they can come in and take something from you, that's considered a secured loan. Whether it's a house, whether it's secured with a CD, whether it's secured with a car, that's considered a secured loan. But it wouldn't surprise me if they're accruing interest every single day because they're being their own finance company, right? If they're a small car dealership, so it wouldn't surprise me if they weren't accruing interest every single day because of the fact that they're just taking a higher amount of risk. So, I mean, I wouldn't be surprised. Let's just put it that way.
Right. Awesome. So I think this is perfect. Mel O, I do want to thank you again just for giving us some time out of your day to enlighten us and bring us these great financial tips. I look forward to doing this again for sure. And we would definitely, be more intentional and just definitely look at to see what more value we can bring to our community and even empower the youth, because I think it starts with them. And if we can get them in the right mindset at a very young age, then that can change a lot of things. They don't teach financial literacy in school, unfortunately, the way that it should be taught. And so I think, people like you, we need more people in this community who can really talk the language and really educate our people. So I thank you so, so, so much. Now, also, we want to thank everyone who has tuned into this podcast. We had quite a few people on Clubhouse as well as on YouTube. We had Miss Cara. I appreciate you, Queen. And also, you all go tap in, go to the finances. What did it say? Finances, the other word.
Finances, the other F word.
The other F word. I like that.
Yeah.
Yes.com.
Yeah, financesothereffort.com. But I'm not very active on Instagram. So if you're on TikTok, I do more on that, which is FTOFW_podcast. I just wanted to throw that in there.
Yes, and also she has a book, okay, that she has written with a lot of financial tips. So I do encourage you all, go tap into her book, okay? Purchase, so you can be enlightened to get yourself on the right path for sure. So I'm looking forward to getting that book, Mel O. I will be purchasing the book because I got a lot to learn, Queen. So I thank you so much just for this conversation for sure. And this is one of many.
I had a great time, though. Thank you for having me on.
Yes, indeed. So with that being said, we're going to go ahead and bring this podcast to a close tonight. thank you all so much for tuning in. Tap into our next podcast. Of course, we will be doing Loyalty and Friends each and every Friday at 8 p.m. Eastern Standard Time. And I'm looking forward to doing more live podcasts. Okay. So typically we are always on Clubhouse. So join us in Loyalty and Friends, great community, but also tap into our live feeds so we can continue to grow this community and enlighten each and every one of you. So with that being said, Mello, any last words before we close it out, Queen?
No, I think that's it. You guys can also, if you have financial questions and you want to do a just a free consultation with me, my investment firm is called Hot Moon Financial. You can find me hotmoonfinancial.com. Like it's hot outside and there's a moon out. That's my investment firm, hotmoonfinancial.com.
Yes, and you can also find her on the OWL app, okay? And it's OWWLL, where you can come on and get a one-on-one personal conversation and also be monetized as an expert. So I would encourage you all come and join us on the OWL app. We will include a referral code for you so you can get your first $10. So anyone who would like to join that community, tap in. Great way to connect with other experts as well. So thank you again. And with that being said, we're going to go ahead and close it out and do our countdown. Clubhouse as well as live. We will be ending this podcast in 5, 4, 3, 2, and 1. Until next time, love you guys. Bye.
Bye.